Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome. Hope everybody is doing well. Thank you for joining us this week. My name is Robert Kuhn, host of this radio show, Destination Retirement, and president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are a fiduciary. I believe that every investor needs to learn more about protective investing. If you have the mindset of protective investing, then you are going to have to diversify in a much greater way than just stocks and bonds. And I continue to see that as one of the biggest concerns that I have. And we're going to talk an awful lot about that today, is when I meet with a potential client or somebody who is looking for financial advice, second opinion, etc., and I look at their current portfolio, it just is stocks and bonds, and you may own many different equities, you may own many different individual bonds, but that's it. And that's not a portfolio that we feel is going to allow you to make money, whether the markets are up, whether the markets are down, or whether the markets are sideways. So protective investing, if that's your mandate, it is something that we are very is a core thesis of everything that we do. And as you know, if you've listened to the radio show, we want to have strategies that can do well, whether the markets are up, they are down, or we are in a sideways market, especially given what's going on in this world today. So we'll talk an awful lot about that this week. We're going to talk about taxes. We're going to talk about alternatives. We're going to talk about distributions. We're going to talk just a lot of new topics that I haven't talked a whole lot about here recently, at least on the radio. So anything any questions you have, any concerns, any thoughts, if you want a second opinion, we're seeing a lot of that today, especially given what's going on in the market. You can always set a initial consultation up with us. That is complimentary. And you can do that by calling Paige. Paige's phone number is 630-492-1912, 630-492-1912. If you are hearing my voice, if you're listening to this show, then we can help you. So we are in the Chicago market as well as several other markets in the United States. So make sure you reach out. So a couple things. Obviously inflation seems to be somewhat tamed. We've had a lot of conversations with clients this week on what a soft landing is. Can the Fed engineer that? It's challenging. Anytime there's a lot of issues in the world, especially in the market, when we're going through things that are relatively new and we haven't necessarily been through before, we have a whole new names for different scenarios. Now we're at a soft landing. Now we're at a medium landing. Now we're at a hard landing. And candidly, I don't know exactly what that means. But our job, I do know as advisors, is to make sure that we have strategies in place that can do well in all of those markets. And so hope we don't think is an investment plan. Obviously, hopefully you don't either. Our mandate as a fiduciary, as an advisory firm, is to make sure that we're helping every client optimize their wealth in pursuit of their best life. And wealth is a unique word. A lot of times people think that there's a dollar amount that makes you wealthy. And what we say, and kind of our motto and what we live by and adhere by as a firm, is making sure that you know that whatever you have that makes you wealthy, whether it's $100,000, whether it's $100 million, or somewhere in between. It truly is customized. customizable. It truly is individualized to you. And the criteria that we have working with us isn't based upon a dollar value that you may have. The criteria really is to, first off, do you need help? And then second of all, are you willing to receive that help? And if you are, then you're going to be a good partner, a good client, and a relationship. Hopefully we have in place for 5, 10, 15, 20, 30 years, because ultimately, that's our job. So as I mentioned, hope is not a strategy. We don't talk enough about that. We believe each account, each strategy serves a purpose. And when you look at that, you have to really figure out what purpose that account or that strategy is serving. Every portfolio strategy should be integrated ultimately with your financial plan and designed to deliver your defined goals. Unfortunately, it's not. We often get asked, what do you think of this investment? What do you think of that investment? What do you think is a pro and a con? I mean, it just simply doesn't matter whether it's a stock, a bond, a CD, a treasury bond, an annuity, a alternative investment. Candidly, it can be the best investment you could make, or it could be the worst investment you could make. It is really defined when we look at it, whether it's a good investment or not, is number one, how does it fit in the strategy? Number two, how does it address your financial plan? And then number three, what goal is it trying to serve for the portfolio? And that's why we say any investment could be the best or the worst, depending upon, what it's trying to accomplish. So something I want you to start thinking a lot about, especially driving around on a Saturday morning. A lot of people don't fully grasp what they have. They don't fully understand what's in their portfolio. They don't fully understand what each strategy is trying to accomplish. If you don't have a strategy in place that can do well and make money when the markets are negative, then let's have a conversation. Those investments exist today. We certainly want to have that as a piece of the pie. 630-492-1912, 630-492-1912. Give Paige a call, set that call up. Because one thing that I find more and more is cookie cutter portfolios. First off, we know they don't cut it. And, most people don't want to recognize that if they're working with a financial advisor, chances are they have a very cookie cutter portfolio, and it's a prepackaged portfolio that are designed for many, but no one in particular. Our portfolios, the way we construct portfolios, they have to be custom built for you and specifically designed to deliver on your plan, your goals, and your objectives. Again, most people that we meet with, they have two asset classes. They have equities in some form or fashion, whether they're mutual funds, whether they're stocks, whether they're ETFs. But again, they're equities, and they're all going to move in tandem generally. And then they have some sort of fixed income, and that fixed income, is in the form of bonds. And everybody has become conditioned to think that bonds are safe. And, since the mid 80s, it's been a very accurate statement because interest rates have done nothing but really trend down and go down dramatically up until, a year or two ago. And now we're sitting in the worst drawdown period of the fixed income market. And so we have seen many potential clients that are down 15, 20, 30, 40% on their safe money. And they want to know what gives. So if that's you, I would have that same feeling. And we can certainly, help you out there and explain why and how you lost that money. And then more importantly, provide opportunities and options to recoup those losses, because I don't think it's going to be done with the current strategies. I think you have to look at strategies that have the ability to make more money than those bond funds or bond strategies are going to be able to recoup, especially in this market. And then, obviously trust and transparency. It's something we talk an awful lot about. I think you have the right to know what you're invested in. You have a right to know the exact amount you're paying in fees. You have a right to know what your tax bill could look like, or if you're reducing your taxable income. And that's something that we take very, very serious. And we'll show you what you own, what you're doing, and what it costs. In this industry, so much is you just don't see the fees. I mean, and it's unfortunate. And a lot of times we'll talk with someone, and our fees are very transparent. You know exactly what you're paying, and we think that there's significant value in the fees that we ultimately, charge clients. But clients, a lot of times they have, they're like, oh my goodness, I'm seeing it. Well, it's really simple. Everybody is for profit, of course. Nobody works for free. Do you want to see the fee? Do you want to know what you're paying? Do you want to be able to identify or judge if there's value being received for the fee you're paying? Or do you want it, hidden? Do you want it, buried where you don't know what you're paying? So we believe in trust and transparency, and that certainly is something that we're spending a lot of time talking about with potential clients. So 630-492-1912. Set that call up with Paige. We'll have that initial conversation. So I think when we look at an edge, I think, we believe that we have an edge, a distinct edge, a significant edge. We're not the only ones that construct and allocate portfolios the way that we do, but we are one of very few. And our edge is, first off, in financial planning, is to design and deliver custom insights and risk modeling that are totally tailored to you to meet your goals, your objectives, not my other clients. And that to me is a very, very big deal. If you're looking for cookie cutter, if you're looking for, when the markets are down, to have your advisor say, well, don't worry about it. Ultimately, it's going to come back. We have to wait a year or two or three. Well, then we're not going to be the firm to work with. We believe that you must incorporate strategies that can do well when the markets don't do well. And those strategies exist today. And we've talked a lot about them on the radio. You know this if you've listened to the show or if you've listened to the podcast. I mean, we're able to craft. We just did a dual directional note last week that was over 15 months in duration. So, relatively short term. It was issued by one of the strongest banks in the world, and it had a maximum gain over 15 months of just over 21%. So if you are content with up to 20, let's just call it 21% gain over the next 15 months, then this was going to be a good strategy for you. Here is what piques most people's interest: the fact that you can make money when the indexes that it's following are down. So from 0 to negative 15%, it has what's called an absolute return buffer, meaning, very simply, if in 15 months the indexes are down, you receive the inverse, up to negative 15. So if it was down 5, your return was positive 5. If it was down 10, your return was positive 10. If it was 15, your return was positive 15. So if the indices were down 0 to negative 15, you just add a positive, and that was your return. Think about that. Maximum gain, 21%. Still made money from 0 to negative 15. And then if the markets were down more than negative 15, if the indices that it was following, rather, were down more than negative 15, that's when you started to lose money. So you had a 15% buffer. So look at negative 15 as your 0. So if the indices were down 16, you were down 1, 17, 2, 18, 3, etc. So you think about that type of an investment, and the minimum investment 10 years ago was probably $1 million, at least $500,000. Today, it's $1,000. I mean, that is it. So every single person should have an allocation to some strategies that can do well in down markets, actually make money in down markets. So I want to challenge you. If you don't have something in your portfolio, whether you're working with an advisor or you're managing the money on your own, that can make money when the markets are down, then the answer is, well, the question is why? And I like to think that it's just lack of education, not your education. It's somebody educating you on the fact that these strategies exist. So that's our job. So if you want to make money, and if you want to have, when the markets are down, if you want to have a strategy in place that can do well, can hedge against a down market, again, whether you're working with an advisor currently or you're managing the money on your own, make sure you reach out. 630 630-492-1912, 630-492-1912, and we'll certainly have that conversation. So next segment, we're going to talk about taxes. We're going to talk about the returns of the S&P 500. We're going to really dive into what is driving the S&P 500. Is it as good as people think? And we're going to talk about inflation and what that means for the remainder of the year. So more after the break. Again, give Paige a call, 630-492-1912, 630-492-1912, and set that call up this week or next.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. Thank you for joining us this week. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm, and yes, a fiduciary. Also the host of this radio show. I like to see our podcast numbers continue to go up and to the right. That means we're doing something right. So I want to make sure to thank everybody who listens to this show on Saturday mornings, and also those individuals that catch it on the podcast. My ask for you is to send it on to somebody that you believe needs to hear the message. One thing that I hear over and over again, I guess I will pat myself on the back, but it's very important to me, is that we do educate well. And my job is to not tell you what you're doing is right or wrong, not to tell you that we have something much better. My goal is to educate you on what you are hoping to accomplish. Can your current plan accomplish that with the least amount of risk? And do you have strategies in place that can do well when the markets are down? And then explain to you in a very understandable way the most cutting edge strategies that exist today for you to do well when the markets are negative, because the up markets, as you know, generally take care of themselves. The key to outperformance, the key to beating this market over the long term, is to make sure we're losing less when the markets are down. We're in an industry where 0.5%, 0.75%, 1% year over year over year add up to a significant amount of money. So I hear a lot of times, well, it's only going to do 0.5% more a year or 1% better a year. Well, think about what that does 10, 15, 20 years from now. Compounded, it can be gigantic. So if you're looking for expert perspective, if you're looking for a genuine partnership, if you're looking for an advisory firm that has an alignment of understanding your challenges, your goals, your objectives, and listening to how we can craft that portfolio to meet those goals and objectives to the best of our ability with the most cutting edge strategies, then certainly reach out to Paige and set that call up for us to have a conversation. 630-492-1912, 630-492-1912, and we'll have that conversation. It's very important, and we take very serious our advice and our planning capabilities. I think our job is to make sure that we're creating portfolios that are built to adjust to changes in plans, changes in goals, changes in market conditions, and that's what I see as a big mistake from most advisors, is that they don't ever adjust clients' portfolios. They don't adjust client portfolios until they call in, and that's a problem. And if that's how you want your money managed, we're certainly not going to be a good group for you. We take a much more proactive stance as to how we manage money. So if you can listen, well, of course, hopefully everybody can listen, but if you can hear this show, if you can hear my voice, then we can work with you. So if you're outside of the Chicago market, rest assured that we are in your area and we are here to help. So 630-492-1912. So let's get into taxes. We don't talk too much. Well, we don't talk enough about tax planning. And if you've listened to my radio show, if you've listened to me speak in person, you understand that I think the most overlooked area of financial planning for investors who have let's just say $500,000 to $10 million of investable assets is tax planning and tax reduction strategies that can greatly reduce your taxable income. We have the rest of November and we have December to invest in strategies that can greatly affect your tax bill for 2023. Tax planning is not something that we worry about in April. Tax planning is a year-long strategy. And I want you to understand that if you have $1 million net worth, okay, that's exclusive of your home. So if you have $1 million net worth, you have access to strategies that can significantly reduce your taxable income. Couple characteristics that you need to know that exist. Number one, you can reduce your taxable income with certain strategies up to generally 75 to 80% of your investment. So hypothetically, you put in $100,000 in a strategy and it's the correct strategy. You could reduce your taxable income, your 1099, your sale of a business, sale of a building by $75,000 to $80,000 on a $100,000 investment. Think about that. That is significant. And what we find with these types of investments, again, some are great, some are terrible. I'm not talking about or passing judgment on the investment, whether it's good or bad, whether there's, there's always risk. It doesn't matter what you invest in. But we have access to a strategy that is in the energy space that can greatly reduce your taxable income. So 75 to 80% of your investment. The other characteristics of the investment are very simple. Significant distributions. The targeted distribution is anywhere generally from 10 to 13% a year. Targeted distributions can be less, could be more, but they're targeting 10 to 13%. So distributions that are paid independent of what is going on in the stock and bond market. So significant tax benefits, significant distributions that aren't going to be affected by interest rates, that aren't going to be affected by the stock and bond market directly. And those distributions are paid quarterly. So annually, targeting 10 to 13%, paid quarterly. The investment time horizon, we like to say, is generally 1 to 5 years, somewhere in that time period. So you have to be able to, part with these monies for a period of time, but generally that's okay, and that's why this should only represent 5 to 15 to 20% of your portfolio. So it's an allocation, okay? It's not an overweight, but it's an allocation. So significant tax benefits, reducing your taxable income, 75 to 80% of your investment. I consider significant distributions in the neighborhood of 10 to 13%, which is the target. And, 1 to 5 year type investment, and the total IRR, which is the internal rate of return, which is something that we look at, is targeted to be between 15 and 25% annually. And when you add these, tax benefits, distributions, targeted IRR, it's not you look at kind of the life of the investment. This is a strategy that you have now 6 weeks to consider to reduce your taxable income. So $1 million net worth, exclusive of your home. Okay. It can be anything. So as long as it's not your primary residence, if you have $1 million net worth, then you have access to this strategy, something that you want to take very serious. You sold a building, you sold a business. If you are a high wage earner, let's have a conversation about it, because it's, again, I would much rather, if you look at, cash on cash returns after the tax breaks, they're significant, and it's a new area. It's in the energy space. And for the first time, we are seeing major oil and gas companies partner with outside partners. And so it's something that we think everybody needs to hear about. If you have $1 million net worth, exclusive of your house. So 630-492-1912, 630-492-1912. Let's have that conversation. And again, tax planning is a year-long thing, but for 2023, you've got 6 weeks left. So that we think buy and hold is a philosophy that is so misunderstood, and Wall Street pushes it. Advisors push it, so they're not actually having to manage risk, and they're out able to bring in new clients. And we're going to talk an awful lot about buy and hold, and without any risk management strategy, how we think that it's overrated. So we're going to get to that next segment. So again, tax planning, if you want to talk about a strategy that can greatly reduce your taxable income. We talked a lot about it this segment. We have 6 weeks left in the year to learn about the pros, the cons, the risks, the rewards, and everything that exists with the investment. Okay, with the couple minutes left here in this segment, buy and hold. So buy and hold is a myth, again, that I think Wall Street continues to talk about. Buy and hold is great, but so is active management. The reality is neither is one strategy that you do 100% of the time. However, what I have found is that advisors want their clients to be conditioned that they can't manage risk, that they can't play defense, that they have to be okay with losing money, so they can be out raising new money to increase their paycheck. And so buy and hold, I think, without any risk management strategy is overrated, and it is unfortunately an issue. So think about this. U.S. stocks have gone sideways for 10 to 12 years with 50% declines during such periods on a few occasions. Okay, so that is very important. You know, if you've listened to the radio show, you know that if you bought Microsoft in 2000, it took you 14 years to get back to even. So markets do go sideways. They go sideways for an extended period of time, and there can be declines of up to 50% during such periods. If you look at kind of the European indices, I mean, they've been flat for, there's periods, almost 15 years. Japan still hasn't surpassed its all-time high, which it recorded 30 plus years ago. And emerging markets truly have not gone anywhere for 15 years. So do you want to trade the market with all of your money? I mean, you can, but probably not. But that doesn't mean you can't have some of your money that tries to take advantage of the market, take advantage of the volatility, can play defense, and then, sell something when you actually make money. Isn't that we're all in the business to do? Buy low, sell high. Yet if you're working with an advisor, very few people have any allocation to take advantage of the volatility in the market. And that's what we're doing. That's why we're unique. That's why we're different, is what we're bringing to the table. And we talk an awful lot about our differences. And if you have any interest in learning about what makes us different, just give Paige a call, 630-492-1912, 630-492-1912. More after the break.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want to find outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, host of this radio show, also president and founder of Kuhn Capital Partners, independent, registered investment advisory firm. And yes, we are a fiduciary. We focus on strategies that can do well when the markets are down. I want everybody to understand that there are strategies that can, number one, protect against market losses or even make money when the markets are down. If you want to learn a little bit more about that, if you want to learn about some tax strategies to reduce your taxable income, if you have a lot of capital gains this year, if you sold a building, sold a business, if you're a high wage earner, we have 6 weeks left to talk about those types of strategies. Give Paige a call, 630-492-1912, 630-492-1912, and she can set some time up for us to have a conversation. So we talked a little bit last segment, towards the end of last segment, what sideways markets look like and how they can be just very, very frustrating and very challenging. And I personally like sideways markets because you can make money if you have an allocation, whether it's 5%, 10%, 15% of your portfolio that is geared towards making money in those types of markets. unfortunately, most advisors don't have that allocation for clients, and it's unfortunate. And I guess that's why we are a popular choice of having us manage individuals' money, because when we look at crafting a portfolio, again, our job is to craft a portfolio that can do well or have characteristics of investments that can do well, whether the markets are up, whether the markets are down, or whether the markets are sideways. Unfortunately, most people are only going to make money in an up market. They're going to lose money in a down market. And in a sideways market, they're going to be frustrated because they're going to see their money go up and they're going to see their money go down. And what if we're in a period of 2 to 3 to 5 years like that? I mean, that is something that you have to take serious. I mean, that's where we're at. The S&P 500 has gone 467 trading days without making a new all-time high. That is, I mean, if you look at the Great Depression, it went more than 6,000. Now, that doesn't mean that I think we're going to be in that period of time, but currently we're roughly plus or minus a few days, depending upon when you're listening to this show, but 467 days without making a new high. And people ask why. And I think a lot of the gains could have just been potentially pulled forward over the last few years. I mean, it's not a conspiracy theory, a tin hat theory to know that since the great financial crisis in 08, 09, that interest rates were basically nothing. Stimulus was plentiful, and look at what it did to the market. I mean, it went up. It went up like crazy. Take me back, or I go back to kind of when I, started in the mid 90s, but started, my first real bull market that I experienced was a couple of years into my career. And we had 2000s, right, where you had people, late 90s, but you had people asking, what am I doing wrong when the market, or my portfolio rather, is up 20%, 30%, 40%? Because people became so conditioned to returns that were just not sustainable. And now the liquidity is really been sucked out of the market. Interest rates are certainly higher. Inflation is certainly higher, and it could be much stickier than anybody could have ever envisioned. And so I don't think we have the tailwind that we have had over the last 5 to 7 years. And I think we are facing headwinds. I think we're facing significant headwinds, and we're not even talking about geopolitical issues. But if you're 5 years out, 10 years out, 15 years out from retirement, or if you're in retirement, a portfolio that can only make money when the markets go up, I think you're going to be disappointed. You have to have a strategy, a portfolio constructed that can do well when the markets don't do well. That is when you know you have a good portfolio. If you want to learn about strategies that can have positive returns when the markets are negative, those strategies exist. They're institutionally based in nature, so they're not mass marketed. You don't hear about them on the TV, but those strategies exist. So 630-492-1912. Because I'm concerned, the top 25 stocks, the largest 25 stocks in the S&P 500, make up nearly 50% of the index versus just over a third 10 years ago. So think about that. I mean, that is, when you look at what is moving this market, I mean, is it all 500 stocks, or is it disproportionately just a handful of stocks? And that's an issue. And that's an issue that must be addressed. That's an issue that, we're seeing a lot of people underperform the S&P this year. Not significantly underperforming the S&P. And there's a reason why. And it really should, be shared with you if you are, why your portfolio is doing that. And if you don't know if it is underperforming or if it is outperforming, then we need to help you, because that's something like we talked about, radical transparency. That's something that everybody needs to know. So 630-492-1912, and we'll have that conversation and go down the path and answer any questions that ultimately you have to the best of our ability. So retail investors, I really saw a very interesting statistic. So retail investors are just generally average investors, 10,000 to several million. They sold nearly $16 billion worth of stock last month. That is the highest amount in 2 years. And if you look at what happened, they sold out when the markets were going down. I mean, we had a rough period a few months back, and a lot of people gave back a lot of gains, and so retail investors sold $16 billion worth of stock, and that includes advisors selling stocks for clients. I have to wonder why. And when you look at a portfolio, and if you look at how a portfolio is constructed, you have to wonder would you have sold those stocks if you knew that you had 15% or 20% of your money that could do well if the markets were down, or if you had 15% or 20% that was protected against market loss, or if you had 10 to 15 to 20% in strategies that greatly reduced your taxable income that paid, target distributions between 9 and 13% independent of the stock market. So what I'm getting at here is portfolio construction. It's not just stocks and bonds, but I promise you 9 out of 10 people driving around on this Saturday morning, that is your portfolio. So we have to focus on things that we can control, because if you look at the top 2 stocks in the S&P 500, which are Apple and Microsoft, they now represent a combined 14.7% of the index. That's the highest weighting of any 2 companies going back to 1980. So again, what that brings me to is if you're not owning just a couple names, you're probably not happy. You're probably losing money. You're probably not keeping up with the market. And, those are things that we have to make sure that we're educating you on, and your advisor's educating you on. But unfortunately, most don't. And that is something that, we have to make sure that before we see, potentially significant losses, that your portfolio, that at least what could happen. Because when we have such a few names that represent such a large disproportionate weighting of an index, if those names stop getting bought, man, we can see things stair step or elevator down. The old adage is you stair step up, so little up, sideways, little up, sideways, little up, sideways, but you elevator down, where you just go straight down, boom. There's not a whole lot of protection if and when a handful of names stop getting bought institutionally, and it's an issue. So we haven't talked a whole lot this show about fixed income. I really want you to stop and look at how you're managing risk, or how your advisor is managing risk. And I encourage you to look at your statements. Generally, most statements will have your asset allocation, or your investments rather, broken out between equities and fixed income, at least at a minimum. Hopefully they should. But look at what your fixed income holdings have done and see if you've lost money over the last 1 to 2 to 3 years. And chances are you've lost significant amount of money in your safe holdings. And that's something that, again, when you have an advisory firm that actually pays attention to detail, that is judged upon performance, that, really talks about performance versus benchmarks, that's something that, we take very, very seriously. And I've seen far too many people lose 5%, 10%, 20%, 40% of their safe money because they were in bonds and they had an advisor that didn't adjust to potentially rising interest rates like we saw. And so who's left holding the bag? It's you. And that's unfortunate because, yes, if you own an individual bond and you hold it to maturity, the chances are you're not going to lose any money. But who wants to see their statements down 20 to 30%? Or what if you have to sell it and realize that loss? Or look at the opportunity cost where you had your money tied up at 2 to 3%, where today, money market rates are paying 5.5%. So those are things we want to talk about. Those are things that we talk about in the initial conversation. It's always about your agenda. And we're going to talk about that here in a minute. I have a good story that I had with a potential client this week. And it really sums up the industry. And I want to share that with you after the break. So 630-492-1912, 630-492-1912. Set a call up with Paige this week and we'll have a conversation. So more after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. Thank you for joining us today. If you're catching us on the podcast, thank you. Please send the link on to anybody that you feel needs to hear our message. That would be very, very much appreciated. Education is at the core of everything we do. Kuhn Capital Partners is independent. We're a fiduciary. We're a financial planning based firm that focuses on protective investing. What protective investing is incorporating strategies that can have positive returns when the markets are negative. If you believe in protective investing, if that's your philosophy like it is ours, you have to diversify a client's portfolio, not just stocks and bonds. You have to incorporate many, many strategies. So if you'd like to learn about strategies that can have positive returns when the markets are down, how that could affect your financial planning goals, your retirement income strategies, your just really the health of your current portfolio, whether you're working with an advisor or managing the money on your own, let's have a conversation. That's it. Simple conversation. We love to have them. We have them all day with potential clients. Some become clients, some don't become clients. That's perfectly fine with us. Our job is to educate. And if we can help you, then, that's all we care about. So 630-492-1912, 630-492-1912. Get with Paige, get some time on my calendar, and let's have that initial conversation and see where it leads. So couple big banks, we tend to leave names out, and we tend to leave individuals' names out because it's just best practices on our part. Just because somebody at a bank or somebody at a brokerage firm says something, I don't know if that person is speaking for the firm, so we just like to not really talk about names. But one of the most significant banks in the world, and one of their chief equity strategist came out earlier in October and said that they are recommending that investors brace for a 20% sell-off and a hit to the S&P 500. So according to this institutional investor, Hall of Famer, with interest rates where they're at and cash that's currently paying 5.5%, right now they're very worried about ultimately a market sell-off. And they believe that they could see a market sell-off of 20%. And so what's one to do when you see that come out, when you see that somebody who has a very, very good reputation come out and say that, hey, we could see a 20% correction, and we're advising our institutional client base to plan for that. And I think that's great. I think it's phenomenal. And I think more individual investors need to hear that. I think more financial advisors who are managing clients who have investable assets between $100,000 and $10 million, they need to talk about that. They need to talk about what would happen to your portfolio if that were to happen, if we did see a 10 to 20 to 30% sell-off in the market. And they're comparing that to this particular bank, and this particular strategist is comparing that to 2007 and 2008. Now, they're not saying that situation is the exact same, but signs of stress are beginning to appear. And what do I think about that? Sure. Why not? Why couldn't the market fall 20 to 30%? And if you had a strategy, if your portfolio was constructed to only make money when the markets are up, well, then guess what? That is going to be a big problem for you because you have nothing in place that can do well to mitigate that downside. And so, you are making an all or nothing bet, meaning most people who are listening to the show today, driving around on a Saturday morning, managing the money on their own or working with an advisor who they think is managing risk. Well, you only have two asset classes. You have equities and you have bonds. That's it. You may have 15 or 20 different individual investments in each of those asset classes, but you only have two things. So when the markets do drop, if this individual is right, if this bank is right, where they see a 20 to 30% correction, then you're going to lose a lot of money. Okay, now compare that to our portfolio construction. Compare that to what we're going to do. Well, we want to have strategies in place that could actually make money if that were to happen. Would our equities go down? Well, of course. I mean, that's okay. I mean, seeing, now how we manage money and how we manage our equity space, I think they would go down significantly less than the market, but nobody can tell you with any level of certainty that that would be the case because it's something in the future. And nobody, as you know, in this industry, past performance is not a good indication of future results. So, yeah. Would our equities go down? Certainly. Do we think they'd go down less than the broader markets? Well, absolutely. But what if we had 20% of our money that would actually have a positive return in a negative market? How would that, your portfolio, how would that contribute to your portfolio performance in a period of weakness? What if we had 10 to 20% that was paying significant distributions independent of the overall stock and bond market? Well, again, that would be a very, very big positive. So if we have strategies that can, that are built to do well, whether the market's up, whether the markets are down, whether the markets are sideways, well, all of a sudden you have a protective investing philosophy. Don't think just because we call it a protective investing philosophy, that doesn't mean that we want to not outperform the market. We want to make as much money as humanly possible. We want to give you the greatest rate of return, but we're not going to forego risk management. And unfortunately, 26 years in this industry, most people listening to the show today, especially if you're working with an advisor, it's cookie cutter. You own two things, equities and bonds. That's it. And that's just not good enough today. So I want to go over a story that I had with a potential client who's kind of going through the interview process right now. And we had a great conversation and learned a lot about them, which is really what our first calls are. So 630-492-1912, 630-492-1912. Our job isn't to tell you what you're doing is right or wrong. Our job is to learn. Our job is to learn what you're hoping to accomplish. Our job is to learn what your goals, your objectives are. And then we can kind of dive into your current portfolio and give you an idea if those could meet your goals or objectives or if there's a mismatch. So we had a conversation with a business owner who I would consider very successful. I love small business owners. I love, businesses that are doing 1 to 5 million in revenue and, is owned by an individual or a couple individuals. And, the cash flow is significant and they saved for many, many years. And that is this individual. And I consider it just such a success story. Working with a big bank where their banker is super responsive. This bank happens to be a good partner of ours as well. Super responsive, and he has a pot of money. I would call it, significant 7 figures, but it doesn't matter if it's 100,000. I mean, this just happened to be 7 figures that he was looking for some ideas on. And if you're working with a bank, generally your bank representative is not your financial advisor or not the representative that makes investment decisions for you. So this person brought in the financial advisor for the area. And they sat together and they had an initial meeting. And the advisor was talking about we want to do a fee-based strategy. So you're going to pay us a set percentage of your fee, which is fine. No issues there. And we're going to diversify your account amongst, small, mid, large, growth, international value, and fixed income. Well, again, number one, that's not diversification. It's diversification in 2 asset classes. So that's a portfolio that's set up to do well when the markets are up, lose money when the markets are down, and then probably lose money when the markets are sideways. So number 2, that's not good enough. But again, that's the pitch, from 9 out of 10 advisors out there. So, okay, I get it. And then the business owner says, well, you know what? Let's look at where treasuries are today. So the 10-year treasury and the 2-year treasury. So why would I not invest in something that I could go out and get and I'll address this here in a minute, but where I could go out and get 4.5%, 5.5% on a 10-year in a 2-year treasury that's backed by the full faith and credit of the government. And he's like, why wouldn't I just do that with my money? I think that's really what I want to do with my money. And he said, you know what, you could hear or see the air just go out of the room. And the financial advisor, his attitude, his thought process, it all changed. And unfortunately, that's how a lot of advisors are, because it's the advisor's agenda, not the agenda of the client. And that's one thing that we pride ourselves on. If you reach out to us, if you take time to call a stranger that you don't know, that you may have listened to on the radio once or, for 2 or 3 years, and you reach out to us, I can promise you one thing. It's not my agenda. It's your agenda. And good advisors who have, significant businesses, who have great clientele, who's not worried about, the next client coming in. I mean, selfishly, I'm very proud of what we've built at my firm. I love the fact that we have great clientele where, candidly, if I didn't bring in another client, I would be perfectly fine. Now, I want to grow because I want to help people. So, that's why obviously we're doing the radio shows to get our message out. But I can promise you it's going to be your agenda, not mine. And I told this individual, I said, well, absolutely. It all is what are we trying to accomplish here? And if you're trying to accomplish, 2 to 3 to 4%, maybe 5%, and that's content, you're content with that, and you want U.S. Treasuries, well, then let's talk about building a portfolio like that. Now, there's some issues there because I think you're just trading one risk, which is volatility and principal risk, for another risk, which is, are we even keeping up with inflation? Are we even keeping up with, inflation after taxes? Because, inflation is high, taxes are obviously high and probably going higher, so we bring, now we're bringing in longevity risk. And, are we going to see the assets grow at the rate that needs to be grown for you to meet your goals and objectives? But again, when you look at crafting a portfolio, again, I see far too many advisors, and I'm going to say it over and over and over again, because this is what I see on a daily basis, that individuals think they're diversified. It's human nature to think whoever you're working with is the best, because you wouldn't be working with them if you didn't think it was the best. But my question to you is, how do you know? Because unless you're in this industry and unless you have a very high level understanding of institutional strategies, there's probably a chance that you may not have the portfolio that you think you have. And so I see far too many people just owning equities and owning fixed income. They'll look at their statement and they'll see, wow, I own 50 investments. I own 100 investments. I must be diversified. No, not at all. Especially if you're with a big bank and if you're with a big brokerage firm, there's chances are, number one, you don't have any tax strategies like we talked about. So, and then your diversification, again, if you want to do well when the markets are up, you want to lose money when the markets are down, and you want to just flip a coin if the markets are sideways, and keep doing what you're doing. And who am I to tell you that that's not something that you should do? It's your money. You can do whatever you want with it. What we have found is we work best with clients who want to have strategies that can do well in up markets, down markets, and sideways markets. And if that is our philosophy, if that is our mandate, we call that protective investing. Don't think just because we call it protective that we don't want to grow the heck out of your money, because we do. But again, our philosophy is if you can make money when the markets are down, the up markets are going to take care of themselves. So with that being said, let's bring the show home here. Let's land the plane on this episode. A couple things: tax planning. If you want to have a strategy, if you want to learn about a strategy that can reduce your taxable income by 75 to 80% of your investment. So you put in 100,000, 75 to 80,000. You put in $1 million, 750 to 800,000. That can reduce your taxable income. 2023, sold a building, sold a business, high wage earner. Let's have that conversation. If you want to learn about strategies that can have positive returns in negative markets, let's have that conversation. So give Paige a call, 630-492-1912, 630-492-1912. Let's have a conversation. Again, make it a great week. We'll be back more next week. Well, we'll be back next week with more information. So everybody have a great week. Take care.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.